Hi, I'm James Robinson, and this is my stock pick of the week. Today we're going to talk about dividends for the company SMP, which is Standard Motor Products. So the dividend yield for SMP is 2.33%. And obviously that's not bad. It's above what the average stock in the SMP 500 pays, which is about 1.5%. More importantly, this company raised its dividend every year from 2009 till 2019. In 2020, the dividend dropped, I should say. But again, I don't think that that was indicative of the business. I think that was indicative of COVID and the fact that the company wanted to marshal their capital in case COVID was a protracted situation. So I don't blame them for that. I don't hold it against them that they dropped the dividend, and I don't think it's permanent, especially when you look at later charts that we're going to show you, which is related to dividends as a percentage of earnings. That also dropped dramatically, which would show that the earnings were fine, just the dividends dropped. And I think we'll get back to normal. It's one of the things that intrigued me about this stock is I felt like we're getting the dividend at a low point and it'll come back a little bit. So basically, again, that's where we are in terms of total dividends. The dividends and dividends per share sometimes will be significantly different as companies buy back a lot of shares. S&P has bought back some shares, but not enough to really change this chart. And so basically the dividends have increased in lockstep with the dividends per share. So I wanted to talk real quickly about better ways to follow me and follow my investing. I don't get a chance to make videos as often as I'd like. I'm busy with my day job often, family commitments, vacations, etc. So sometimes it takes me a little bit of time to get these videos out. If you want real-time information when I buy or sell a stock, or when I see information I think is relevant to one of our companies or to the market in general, you can find that on my Twitter page. My handle is @RobinsonStocks. So again, real-time information on trades, updates when new videos are posted, and news and thoughts on the market can be found there. Also, I'd like to thank all of my subscribers. I have 376 subscribers. Obviously, the goal is to get to 1,000 subscribers. That's the first tier at which you can start making a little money off YouTube. Not that I plan on making a lot of money off of this, but it'd be nice to be able to take my family out to dinner or something. Finally, you see here a map. This is where my known subscribers are around the world. It's really kind of cool for me to see that people all over the place are following me. So if you're following me and you have a second, just drop me a line in the comment section and say, hey, James, I'm following you from, Zimbabwe, or from, China, or from Tucson, Arizona. Wherever you're from, I'd love to hear from you. Thanks. So we've talked a little bit about the yield, and we've talked a little bit about how the dividends have grown. I look at dividends a little more thoroughly and a little more deeply than that. I look at dividends in terms of four factors. The first one we've already talked about a little bit, which is yield and growth. But then I want to look at dividend safety in the context of earnings. So how much of the company's earnings are being paid towards dividends? To give an extreme example, if a company's paying dividends equal to 150% of their earnings, that's not sustainable. If a company is paying none of their earnings in dividends, that's not attractive. Somewhere in the middle is the right point, and I want to get a sense of where that is. Next, I look at dividend safety in the context of cash flow. Again, that's related to earnings, but maybe perhaps more precise. And then I look at dividend safety in the context of the company's current debt load. When a company has debt, they have an obligation to pay interest. If the interest rates were to increase and the company didn't have the wherewithal to pay down the debt, their debt service cost over time would increase commensurate with the increase in interest rates. And so what I want to look at here is how much of an impact would higher interest rates have on a company's ability to pay debt. And I think this is important today when we're in a super low interest rate environment, but we're also in an inflationary period. Those two things don't seem like they can consist simultaneously for very long. One of them is going to have to win. Either inflation is going to go away or interest rates are going to have to rise. And so I want to make sure that the companies that I own, my dividend is not going to be gobbled up by interest payments. So here you can see a chart that looks at the yield. The company's yield is 2.34%. The average yield for the S&P 500 is 1.57%. So again, this company is 50% higher than that. If you look at this chart, it's a little misleading because this will show that the average growth of the dividends has been negative 1% in the last 5 years. It's not really accurate, not once you consider COVID and bring COVID into the equation. The company actually has done a pretty good job of raising dividends, in the range of 8 or 10% every year for the last 5 years. And then last year they dropped it by 50%. And that's what created this net loss. But again, if you look at it in the aggregate over the last 10 years, the company's done a pretty good job of raising the dividend and in a way which is significantly better than inflation. So it's creating earnings. It's a company that I would not be opposed to owning as part of a retirement fund if I was looking for income. The dividend's not great, but the fact that it's been growing consistently and the company is got a kind of a moat around it is something that makes it very appealing. So I would ignore that. So just so you look at this chart, the blue line is where the dividends per share were, and then the red line looks at the increase the red bars look at the increase year over year. And again, the last year, because of COVID, it dropped significantly, but that's not consistent with the way the company's typically operated. One of the things that I really look at is dividend safety in the context of earnings. So how much of the earnings is the company paying out in dividends, and how sustainable is that? And so you can see here the dividends per share is the orange bar and the earnings is the green bar. And you can see that the company's not paying very much out in terms of earnings. The current payout ratio is 19.9%. That's very, very low. The average dividend payout ratio of the SMP 500, for example, is 40%. And that number is actually low again, even in the years before that, the average payout for the last 5 years is 34%. When you subtract last year, it might be 45%. So this company is not paying out a tremendous amount of money in terms of dividends. So the dividend, therefore, is very, very safe. This company could probably afford to increase its dividend by 50% and go from 2.5% to 3.5% or 4% yield and still be still be able to maintain that dividend for a very long period of time. So dividend safety in the context of earnings for this company is very, very strong. And it's, again, one of the reasons why you should feel comfortable owning this if you're an investor looking for income, or at least if you're an investor looking for a very consistent income, which is likely to grow over time. So dividend safety in the context of cash flow. This was almost a disqualifying chart for this company for me. I didn't buy this company strictly for its dividends, and so it's not the end of the world for me if there is an interruption of dividends. And this chart or this table would tend to believe that might actually occur. In the last 5 years, this company has made about $83 million in profit. Excuse me. In the same period of time, they've had about $180 million in capital expenditures. So those capital expenditures have been $100 million more than the earnings for the last 5 years, which means they've had negative free cash flow, which means they've had no cash to pay dividends. Now, part of that, I believe, is the fact this company has been buying several companies and perhaps using that money to modernize those plants. But this is something that I will keep a close eye on. If there is some concern about the long-term dividend payment for this company, and we want to keep an eye on what's happening here, certainly you can't continue to have capital expenditures outstripping income. So what I would like to see is that these capital expenditures either dramatically decrease or that we see the income is starting to go up as a result of reinvesting this money intelligently in the business. I don't like companies that need huge capital expenditures, especially as it relates to income and not something that's sustainable. So we'll keep an eye on that going forward. So dividend safety in the context of debt, I could go through this table with you, but this company has so little debt that it's really not important. There's no, at 20% interest rates, it creates a reduction in cash flow of about $4 a foot. The new interest adjusted cash flow is $44 million, $7 million in dividends. So this company's not going to have a problem paying its debt, paying its dividend, at least not as it relates to interest expense. I'm still concerned about its capital expenditures, capital investment that they've been making, but we'll keep an eye on that. But the other three categories are also solid for this company, and the business model itself is so solid. I'm always willing to overlook one red flag because no company is without red flags. But just got to keep an eye on that red flag as things evolve. So that's it for dividend safety for dividends for SMP. Long story short, 2.3% yield, better than the S&P 500. With the exception of COVID years, it seemed to have been growing about 8% a year. As a percentage of earnings, they're not paying a lot in dividends. However, as a percentage of cash flow, it's a problem because the company's been investing so much in capital expenditures in the business. We want to keep an eye on that. Debt's not a problem. So that's it for SMP Dividends. Thanks.